3 cuts in a row from the Fed, but the easing path ahead isn't so smooth. Fed officials are primed to deliver a third straight rate cut later today, but that might be where the streak stops. Stubborn inflation has split the central bank, and Chair Powell must speak for all of them. It's a tough message to deliver and even tougher to navigate. So where does the Fed go from here? Josh Passmore, Investment Director at Artemis Investment Management. So Powell hasn't spoken publicly since the October decision. Is he walking into an even more fragmented committee?
There's certainly a chance of that. So if we go back to last time, the dot plot was a bit of a mess. So you had sort of a 1.5% spread from memory between what different members thought was the appropriate rate at the end of sort of 27 and 28. And I guess on the one hand, you could say, yes, unemployment has risen to a 4-year high. On the other hand, you've got equity markets at all-time highs. There seems to be ample liquidity. So there's a bit of a tug of war between those factors. All in all, I think, given those sort of forces, it's very likely that we have a good amount of dissent.
Well, official November data won't be released until after the meeting due to the shutdown. How convincing will the hawkish voices be without that evidence?
They probably would have wanted some CPI data before today's meeting, and indeed they didn't get any in October. Look, I think we can still be quite wary of the risks that the hawks might point to. The last CPI report we got was from September. That showed accelerating inflation. And again, there just doesn't seem to be a massive need to cut. Economic growth is pretty strong, equity market at all-time highs, as I've already said. So yeah, I think that's important. But actually, there is one sort of dovish voice that we certainly can't ignore, and that is the president, who tends to sort of drown out the other narratives from the Federal Reserve at the moment. So I would agree, but there's a significant dovish voice that's difficult to ignore.
So Josh, with cuts pulling yields down from the post-pandemic highs, the easy income era is fading. With equities looking expensive, how should portfolios position themselves?
Yeah, it's a fair point. Look, I mean, equities are expensive at an aggregate level, but actually, if you take out some areas like mega cap technology, which are increasingly dominant in global indices, there are still some decent pockets of value. You might look at healthcare, weakest sector globally year to date up until very recently. The UK looks pretty cheap despite being up 20% year to date. Emerging markets, where you've got sort of corporate governance reforms, attractive valuations. So I think outside of the US, there's some quite interesting income opportunities in equities. And maybe in terms of fixed income, an area we quite like is the short end of high yield and the higher quality end of high yield, where you can get nice yields. Yes, spreads are tight, but actually if we sort of dig into individual securities, we think there's a good amount of mispricing there that we can take advantage of.
Let's turn to the FX space though, and pricing for a second cut in 2026 is wobbling. And on paper that is dollar positive, but could a rally last beyond what's already priced in?